Thanks very much to the ABA for the opportunity to present to you today. Today I wanted to talk to you about credit arrears and hardship. Obviously, in the current economic circumstances, there's a lot of concern around what's going to be the impact on consumers and businesses as a result of combined impacts of cost of living and interest rates. And when is that going to start to become evident? So starting off looking at repayment arrears, and in an international context, I think it's useful to be able to look at delinquency in some comparable jurisdictions. So looking at personal loans initially, so we're seeing some moderate trends in personal loans, predominantly some increases in the likes of the US and Canada. But particularly Australia and New Zealand, even the UK, very flat trends, and not a lot of impact coming through in terms of personal loan delinquencies as a result of the impacts to date. Mortgages as well, likewise Australia and New Zealand not showing a lot of change there. In fact, in Australia, we've seen quite a bit of decrease in the last few years, a little bit in the last couple of months, which I'll come to in a little more detail in a moment. New Zealand also starting to pick up over a slightly longer time period. Similar jurisdictions also, UK in fact declining, US increasing a little bit. So at the headline level, not a huge impact. When we delve down to the next level of detail, looking at Australia and breaking it up between first home buyers or first mortgagees and other mortgagees, we're seeing some increase particularly during 2023 as those impacts start to have some effect. Also, a little bit of a widening of the gap between first home buyers and existing mortgagees in terms of that increase in arrears. So there's obviously some additional impact coming to those first home buyers, perhaps due to their having less experience in dealing with changes in interest rates and cost of living, and the different circumstances that they may find themselves in. So we're starting to see a little bit of impact coming through there. When we then look at financial hardship, and financial hardship, for those of you who are not aware, started to be contributed as part of comprehensive credit reporting from July last year. So it's a relatively new data set that we've had access to. Looking at trends, particularly over the last 6 months in that data set, and we haven't seen a huge increase in the number of hardships being reported to us month on month, which is a good thing. So there's certainly a little bit coming through in the March number there. So not a huge impact coming through. When we look at by the number of hardships by score band, as you would expect, those that are more credit stressed, lower credit scores, are showing higher proportions of hardship. Now, there's a couple of interesting things there. So the majority of the hardship that we've had reported to us is in mortgage portfolios. So about 47% of the accounts that we're seeing in hardship are in mortgages. And mortgages are predominantly in those right-hand score bands from 800 and above. So yeah, there's not a massive impact coming through there. But the fact that it is coming through in those lower score bands, because financial hardship itself is not included in the credit score. So it's not the financial hardship per se that is decreasing the individual's credit score. It's other information. So what is that other information? Well, prior to the declaration of hardship, there could be arrears coming through in those portfolios. So perhaps those individuals aren't looking for hardship assistance early enough in the cycle. Likewise with other credit facilities that they have. They might have applied for hardship on their mortgage, but they have other credit facilities that they're not seeking hardship arrangements in, and perhaps those facilities are falling into arrears. So I think that highlights the importance of the need for early intervention when individuals do become credit stressed, to be able to engineer a good outcome. And I guess particularly for those of you that have either mortgages or a main financial relationship with the individual, being able to get early visibility of an individual's credit stress situation will be important to be able to engineer the best possible outcome for that individual. But we don't just look at hardship and arrears, we look at a range of different indicators that we can see that could indicate people looking for financial assistance or showing credit stress. And so we've been working for a couple of years now on what other measures can we look at. And we've built a proxy that looks at some of those other measures. So where we can see that on term facilities, amortisation rates have changed. Have they reduced? Have they dropped to zero? Have they even become negative as an indication that there are reduced payments being made on those facilities? Secondly, and particularly prior to the introduction of the financial hardship information, the common practice was to suppress the repayment status for individuals that were in hardship. So another indicator of potential activity happening on the credit file. And lastly, looking at the repayment status in advance of restructure type activities, changing from P&I to interest only, or restructuring the credit facility. So taking some of those other indicators together to be able to get some early indications of where there's credit stress occurring in individuals. And what we're seeing is that, well, certainly we know in 2020 there was a lot of financial assistance programs offered right across the industry. And we saw a significant increase in this early intervention indicator or the financial assistance indicator that we'd developed. And that since 2020, thankfully, has dropped down to much more manageable levels. But there is an increase in the baseline over pre-pandemic, and quite a reasonable one there. So, and there's probably a number of valid reasons for that. So there was certainly during the pandemic a lot of media coverage, a lot of coverage around deferrals, around financial assistance for individuals to manage through that period, and that is continuing to promote such services going forward. And likewise, lenders have done a lot to improve their ability to be able to deliver financial assistance services. And I believe on the panel this morning that there was some discussion around individuals reaching out to banks looking for potential options for the future in terms of hardship assistance. Tracking that indicator a little bit further on, we looked at, okay, they've shown signs that there's some need for financial assistance there. Well, what has the outcome been? And we've seen, pleasingly, an increasing trend of those financial assistance indicators resolving. So where we've seen returns to normal levels of amortisation, we've seen repayment status being contributed once again, and we've seen restructures within the same lender so that they have been able to get into a better scenario. So it's pleasing to see that those rates of resolution have continued to improve. So looking at where we are, so certainly we've seen a number of indicators of arrears. Generally, they've been pretty muted at this point, which is good. Shows that consumers, to this point at least, are being able to manage their affairs, and will continue to watch not only the delinquency and late arrears, but also early arrears to be able to get early visibility. We've also seen that the hardship programs and the use of financial hardship information on the Credit Bureau has been quite effective, and it's helping to promote early intervention to be able to resolve the situation for consumers. Lenders too, we're finding, are looking for ways to better engage with their consumer base, to be able to identify financial vulnerability. And we've had a lot of discussions with lenders about how they can potentially use credit reporting information to identify where there is credit stress occurring for individuals that is not necessarily in the portfolios that they hold. And certainly there is abilities to be able to do that so that the lenders can then be more proactive in reaching out to customers to contact them, to promote assistance services where they're warranted. And like I was saying before, with where you have the mortgage or main financial relationship, be able to restructure that at an early stage rather than waiting until the arrears starts to become more significant further on and more difficult to restructure. And lastly, we are seeing, as I've said, the resolution rates improve over time, and certainly we hope to continue to see that. So that's all I had to present. So thank you very much, and we do have a couple of minutes left, so I'm happy to take some questions if anyone has one.
The audience has got a question they'd like to ask of Robert. Thank you so much for filling in at short notice too, mate, in Lisa's absence. Have we got any questions from the audience? Just try and look out through the glare there, through the glare. We're good. I think you've dazzled them to such an extent, Rob. They are absolutely speechless. Give Robert Musgrave a big round of applause. Thanks so much, mate.
Thanks very much.
Continue, mate. Thank you very much.